don't have to go anywhere else to get one. I have it here. It's brilliant.
Great. So, if you didn't get it from that video, what we're doing is actually very simple. We take solar energy hardware, that's a PV panel, photovoltaic panel, a lithium-ion battery. We sort of wrap some software around that battery, LED lights, low-power TVs, and then we put mobile connectivity technology inside that hardware. So I can remotely control that hardware and turn it on, turn it off, and monitor its performance. And then we allow the customers, we put that on our balance sheet, so that's that product, M-Copa buys that in China, we bring it into Africa, and we say to the customers, instead of spending 50 pence a day, 50 cents a day on paraffin, pay me 50 cents a day, and you have this clean energy equipment, and you are buying that asset. So we are microfinancing the clean energy equipments for the customer. And it's really simple. Instead of 50 cents a day on kerosene, 50 cents a day and you are getting clean energy, and at the end of 12 months, or however quickly you repay us, you own that product. And then you're not spending any more money on paraffin or energy again, until the battery dies, of course, which is 5 years, typically. So we believe we save every household $450. Once they bought that product, they save $450 for money that would have been spent on kerosene or paraffin. But for me, that's only just the start, actually. That's one big benefit in a household. Clean energy, getting rid of kerosene, which is a very dirty and dangerous fuel, and they own an asset. And that allows us, once they've demonstrated they can repay on a regular basis, we allow them to refinance that equipment. Because it's remotely connected, we can allow them to use it as collateral and then take a loan for anything else. We simply reset the credit balance on the power system and say, now you can have a loan for school fees, we'll give you a water tank, we'll give you fertilizer, we'll give you credit for other things because you have demonstrated to us that you can repay that solar home power system. And if you don't pay us for that water tank, ultimately we can turn off your home power system. So it becomes a mechanism by which we can offer credit for many other things. So it's a form of collateral. And we turn that model into, we now think about lifetime revenue. We sell the first product, but actually, I'm sorry, the slides are moving a little too quickly, but over time, we can refinance that customer. If they demonstrate to us that they're good at repayments, we'll offer them credit for many other things. Because of course, at the end of the day, we still have the control on the power system. Does that make sense? We can see a revenue opportunity of north of $1,000 per household for good customers. And that's because we're really in a financing relationship with the customers around a connected energy asset. So actually on the video's a few years old, we wanted to reach 1 million customers, and we're a little bit short now, and we're about a year behind schedule. But we have around 850,000 customers now. We employ about 800 people in Nairobi. We're in Uganda, where our operations work, and we're just starting to explore other markets around the world. We've built a platform which is the heart of our proposition, which is really a fintech platform. This is all cloud-based. We use machine-to-machine technology. For those technologists in the room, we use an actor system. So we create a virtual representation of a piece of equipment in the cloud. We can do software updates to that virtual equipment. We can control the state of that equipment remotely. And we get a lot of insights from the data. So because we can watch that product being used in real time, we can see if the batteries are performing well enough. In fact, we can anticipate through machine learning, we can anticipate when a battery is about to fail so that the customer never has a type 1 failure and stops paying us money. We can intervene I'm sorry, I don't know what's going on with my slides. They're moving without me pressing the button. But we can intervene and swap the unit out if we think the battery is failing. So it's all about data, real-time visibility of customers, understanding good payers, slow payers, fast payers, high users, low users, all because they're connected to us and we're doing this all through digital. Underneath it all is, of course, M-Pesa, and that's the mechanism by which they make payments. So I think that's really exciting, and I hope you share my enthusiasm for that type of product. This is an energy product, but at its heart, it's really financing. So now I'm trying to move forward and it won't go forward. Great, thanks. So my last few minutes, just a few of the risks that are involved here. So, many times, and this is especially true with blockchain and crypto, I've seen many business plans in this area, and I read them, and I can't understand what customer problem is being fixed. It really, I spend a lot of time looking at these ideas, and if you haven't been able to describe the customer problem you're solving in one sentence, I would argue that you don't actually have much of a business case yet. Now, it will come. As I was saying earlier, I'm excited about blockchain and digital ledgers, but let's stay focused on what the customer actually wants. So with M-Pesa, it was moving money A to B, simple as that. Do it securely, do it quickly, do it at a fair cost. With M-Copa, we're displacing kerosene costs, and we're allowing you to buy an asset. If you can't describe what problem you're solving, please recheck what you're trying to do with your crypto or your blockchain proposal, because it's fundamental. And then, of course, what are the biggest challenges? Now, with M-Pesa, I talked about that interface between real money and e-money. If you haven't got a distribution network, you also don't have a mobile money business. If you've got to concentrate on putting agents out there in the field where customers can go with real money loaded into their wallets, and in Kenya we have 170,000 agents in Bcash. Bcash is now nearly in excess of 30 million active customers, and we have about 220,000 agents. If you haven't got that agent network, again, you're going to struggle to grow that mobile wallet business. Getting that agent distribution network in place is critical because of the interface between cash and e-money. M-Copa, we had some other challenges. Working capital, I'm sure you can imagine. When we're buying equipment for dollars in China, shipping them in and financing them in Kenya for shillings, we had a major problem in our first few years around working capital. We now have a fantastic facility led by Stanbic of $65 million revolving capital. So that problem has gone for us, but in the early days, that was one of our biggest challenges. Online, and I'll circulate this to the organizers as well, but we've just published our own impact report for M-Copa, where we look at things like how much carbon have we saved, how many hours of lighting do we provide to users, how many jobs have we been created. And that's an impact report that I'd very much like to share with the team here, because again, we can make a huge difference to people's lives with this sort of technology, and we've just quantified some of this in our impact report. So, next slide, if possible. Great. So my top 3 risks, and this echoes some of what's been discussed over the last few days. There is a growing concern in Kenya that digital credit is almost too easy to get. For those of you that have been in this space for a long time, we've been here before with the microfinance bubble, when there was over-indebtedness happened, and the microfinance sector really suffered as a result. There are some voices now, some very experienced senior voices saying, actually, digital access is too easy for people to get. They can quickly figure out how to get a score on a credit rating agency, take a loan, and then go to the next person and take another loan. That does cause problems, and I think we've got to be very careful that we don't fall into this trap. In Kenya especially, there are things like Sport Pesa and Bet Pesa, and these are, for me, that's the sort of unintended consequence of digital finance. It doesn't feel to me like that's a very healthy, it's a personal opinion, of course, but is that a healthy development on the back of digital finance? I don't know. What we do in M-Copa is we link those payments to an asset. For me, that's the way to go. Link those repayments to something which is valuable to the house or to the business. I haven't heard yet much talk over the last few days about the big social media platforms coming into this space. Facebook, they have huge reach. They've got lots of dollar firepower. They could displace the banks. The banks worried about the network operators, but I think network operators and banks should both be looking at the social media players and thinking, are these guys going to step into the financial services space? Some of you that track this through Libra Facebook's proposition. You know, we've got to be aware that there are going to be new players coming in, and some of these new players are very big. Now, I'm a big advocate of rapid innovation, as I was talking about earlier, and I think if you're innovating, we'll stay ahead of the curve. But actually, there's this worry also about black hole economics, where these big companies swallow startups and either kill them off or you know, absorb them. And that ultimately, in the long run, that might also not be good for market dynamics. So I worry a little bit about this black hole economics theory of the big boys dominating the financial services space, and it might be the big boys from the social media world. Okay. I know you're trying to get me off the stage, so I've used my time, and just moving to my very last slide here. So I didn't want to end on, okay, so I was also, my third risk, this is keeping you all on your toes as you're going backwards and forwards on my slide, but my third risk here was the availability of the right skills and resources. I mean, we are constantly looking for data scientists. We have to address, in the private sector, we need to think about data security and privacy in a very different way to the way we thought about it before. We're seeing the ownership of data, I think, move to the consumer. And we need, as a private sector business, we need to be able to change our organizational structures and the way we manage risk to address that. And I think in the regulatory side as well, I think that's really important. These are new things, and actually keeping pace with the technologies is very hard. So I didn't want to end on the risks. I wanted to end really on you know, just what we can see ahead of us. And if you think about connecting any piece of equipment and being able to finance it, this is way bigger than solar energy and TVs. And you know, we're already selling fridges, for example. We sell connected fridges into small shops. That small retail owner will make money every day because they've suddenly got a powered fridge which they're paying literally $1 a day for, and they can make more than $1 a day because they can sell cold produce and they can store preservables for a lot longer in their small business. So if you think about a productive asset, connecting it and financing it, I think that's a really exciting opportunity. And then finally, we've just started testing how we can lock a smartphone using this technology, pay-as-you-go technology. And we've got a trial going with several thousand users in Kenya. The smartphone is the phone. It's going to be the screen of choice for many, many things. TVs, I think, could almost disappear. A lot of the young generation coming through in Africa today, they can afford a smartphone. They do everything through that smartphone. And so if we can find a way to finance smartphones, good quality smartphones, and allow customers to use that as an interface in an affordable manner, actually I think that smartphone becomes a gateway for many other products and services. So I'm way out of time. I'm sorry to the organising panel. I've blown it by a few minutes. But I'm here all day. We didn't have time for questions. But if people do want to talk to me about this, please feel free to come and see me during the day, during one of the breaks. And I'm happy to answer questions on this. Thank you very much.
Thank you very much, Bruce, for highlighting the example of Mesa and Copa. Keep experimenting was one of the key messages we had. And I think we experimented yesterday with picture-picture presentations, and somehow we see that our PowerPoints are still moving every 20 seconds. So maybe we have to check if the function is still on it every 20 seconds, the slide. Sorry about that. So you talked a little bit about social media, Nick. So the next session I'm very excited about because also we like the title. We try to have an exciting title for every session. So central bank digital currencies, the good, the bad, and the ugly. And Nick, you touched on that one as well. So can actually central bank digital currencies ensure a more stable financial system? What is the impact on financial inclusion? We are going to explore that question with a panel. And may I request our moderator and our panelists to come here on stage, and I will introduce you only to the moderator, and then he will introduce our interesting panelists. May I request our 5 colleagues to join here on stage. And we anticipated a delay of 15 minutes, so we had 15 minutes buffer time. So if we stay on time, everything is fine. So I want to introduce you to our moderator for this panel. He's a global digital banker, a fintech expert, a futurist, and an author. He has been listed on many lists, for Champion Singapore 2018, and also on the 20 FinTech experts to watch out for in Dubai 2019. He has a 40-year career, I think, in Citibank before he actually founded a FinTech venture growth platform called Innovation Labs. He also was part of the panel for our AgriFin hackathon, Mr. Junkyo mentioned. So please give a warm welcome to the co-founder and chairman of Innovation Labs, Malik Khan Kataya. Over to you, Malik.
Thank you very much for that kind introduction. Good morning, everyone. We'll try once again. Good morning, everyone. Yes, I mean, after such an inspiring presentation by Nick, I think at least my spirits and my energies are extremely high. Actually, before I get into the panel introduction and start the panel, I did want to share that there were 3 interesting things that Nick mentioned, which actually beautifully segue into what we are going to discuss today. And these were my 3 key takeaways, I should add. He beautifully articulated, and we know the story very well, but still he articulated it well. E-money or digital money and inclusion, a real life example. 2, he very well articulated cryptocurrency. What problem statement is it trying to solve for? And many of us who've been in this space, including Professor Lee for a long time and who are experts like him, have been hearing this for a very long time. Is it a solution in search of a problem? So, and then we, of course, discuss this in a great bit of detail. And the 3rd, he spoke about bubble. So we will look at all of these aspects and more. And on that note and that segue, it's my absolute pleasure and delight to be moderating this very important topic with 4 great panelists here. I will do a very quick introduction, but I will then actually request my panelists to do a more detailed introduction. So right next to me is Professor Dr. David Lee. For those of us who are in Singapore and in this ecosystem for quite a while, he needs no introduction. He's a very well-known personality when it comes to blockchain and fintech and all things inclusive digital finance. And I've obviously had the pleasure of sharing the stage with Professor Lee many, many times all over the world, from Las Vegas to Taiwan. So it's a pleasure to be back with him again. Next to him is Vijitleka Marom, or Leka as I call her. She again is driving the central bank, the project Inthanon from the Central Bank of Thailand, and she will share her actual real life perspectives and experiences. I've again had the pleasure of sharing the stage with Lekha many times over in different parts of Asia as well. Then we have Sarath from the National Bank of Cambodia, and he will share the other perspectives, wholesale versus retail. And finally, we are very glad and fortunate to have Marcello, who's just joined IMF. We were chatting yesterday, but he's made the effort to fly in all the way from Washington, D.C., and he's probably a bit jet lagged. So we hope he's had his coffees in the morning. I would request, probably starting with Marcello, to maybe do a little more of a 30-second introduction, more in the context of what you are doing in this space, and then we'll get started. Thank you.
This one is working. Okay, perfect. So thank you very much, Malik, for the introduction. So I'm Marcello Miccoli. I work at the IMF in the Monetary Capital Market Department. I follow there the digital currency space. We are several people in the IMF trying to understand what are the implications, the cost, the benefits of digital currency. And we are currently undergoing a lot of thinking about what's going on with this space. Is there something that good is going to come up with all the discussion analysis of having central digital currency, and especially central bank digital currencies provided?
Good morning, everyone. And my name is Sarat. I'm from the National Bank Cambodia. And just want to give you a little bit of background. The National Bank Cambodia at the moment is piloting the project, what we call the Project Bagong, which is basically we try to test the use case of the DLT technologies. We employ the IORA Hyperledger from Japan. I think some of you might heard about this platform. So at the moment we are in the pilot stage. It is the production already, but we still call it the pilot stage. So we still observe the progress of the projects, and then we will discuss with you more on this when we go along the discussion. Thank you.
Very good morning to everyone, and thank you for having me here. Thank you, ADB, and our esteemed panelists here. And I'm from the Protect Department of Bank of Thailand. Right now, we have done the proof of concepts on doing the wholesale central bank digital currency, which is a bit different from the retail one, which I will explore with you later. And the main purposes of the project was to gather all the stakeholders to explore the opportunities of using the new technologies like this distributed ledger technology, whether it can give you the benefits on using within the wholesale interbank settlement like RTGS, and also having the opportunity to do the capacity building with the stakeholder to be on the hands-on project. So it's just a proof of concept, but we've done and we are within the third phase right now, and we can share with you later too.
Good morning, everyone, and I'd like to thank ADB for inviting me here. It's a great pleasure. My name is David Lee. I'm from the Singapore University of Social Sciences. I learn, I write, and I share about inclusive fintech. And at the same time, I invest and work with companies who actually work in the space from connectivity inclusion to identity of the refugees to also tokenizing livestock.
Thank you, everyone. And I have so many questions. I'm sure the audience has many questions. So this is a subject which we've explored over the last 3 days, and I can sense all of us are kind of here because there's a lot of curiosity, if not hype, and many questions about this topic. So we'll obviously look at it from multiple dimensions. We look at the what, we look at the how, we try and explore the why, which is, to my mind, quite fundamental. And hopefully we'll try and look at the when as well. But before I jump into the questions, I just want to kind of give a little bit of context for perhaps 1 to 2 minutes on why we are even here and talking about CBDCs. So for folks like us who've been in the ecosystem, blockchain and cryptocurrency ecosystem for quite a while, it has been a logical and a progressive evolution. It's not a kind of something which flashed overnight. So it started with Bitcoin about a decade back and Satoshi's famous white paper, and that was a direct fallout of the 2008 banking crisis and the loss of confidence. So this idea of democratization and decentralization of money and power to the people, peer-to-peer, kind of similar to what Nick articulated. So there was a parallel movement which happened around the same time, but it was largely in the community of the geeks. And that continued for some time. A few years later, I called it the evolution of 2.0, where Ethereum came about, and the idea that Bitcoin is quite limited in what it can do in terms of its features and functionalities, in terms of transaction speeds and its scalability, etc. So Ethereum came about, and on top of that, this whole ecosystem of D-apps or distributed apps came about, and I have lost count, but probably more than 3,000 tokens or alternate coins were issued, and that kind of spawned a whole marketplace. But as we saw, that had another flip side. It spawned a lot of volatility, a lot of speculation, pump and dump, wash trading, front running, all the ills that were typically associated with the mainstream markets crept into this, and in a much more unregulated way. So then we evolved to 3.0, and the idea was that if this economy or the token economy has to become viable for mainstream banks, for mainstream corporates, then you have to move beyond volatility and the speculative aspect of it, either as a monetary instrument or as a settlement instrument. And that's where stable coins came about, the idea that you have to peg it to some real world asset and make it more stable, less volatile, more useful for the mainstream market. And while that has been around for a decade, the big trigger, as we all know, was the announcement of Facebook Libra earlier this year. And suddenly we saw a flurry of activity from central banks as well, saying that, yes, this is not something we can wait and watch. We have to take a position soon because, a $2 billion strong entity. The largest nation in the world, Facebook, has already announced a consortium, and we need to take a position whether for it, against it, need to study more, etc. And we need to then seriously look at our own digital currencies as well. So this is a little bit of a backdrop so that we all appreciate how and why this came about. On that note and on that segue, let me jump into the most fundamental and the root question, and we'll start with you, Lekha, and then Professor Lee, we'll go this way. In 1 to 2 minutes, can you share with our delegates what is your definition of CBDC? Because this itself seems to be, there seems to be so many points of view. So let's start with the basics. What is your view and what is your definition of what a CBDC is? Thank you.
Thank you, Malik. So basically, central banks are the bank of banks, bank of all the banks in our jurisdiction. And we have the main responsibility to do the financial stability and provide trust, especially the currency that we issue. So CBDC, as the name comes by, is issued by the central bank and backed by the fiat currency that we have the power on. I mean, we have sovereignty on that, and we use as the means of providing the